Okay. All right. Well, thank you all so much for joining us once again for our AgLanta Grown and East Point Grown collaborative agribusiness training webinar series, where we are partnering with Good Agriculture for an amazingly robust webinar series. And tonight we actually have a special guest presentation, Attorney Kenneth Lester, who will be giving us some information that may be little known information, but it's extremely helpful about an additional funding source. And to start, though, Good Agriculture will be leading the presentation, discussing grant opportunities, cost share, different credit programs. And yeah, this is an amazing opportunity for our fourth webinar in our series of 7. And so glad that you all were able to join us this evening. Without further ado, we'll get started with some introductions. I'm Justin Nicholson, joining on behalf of AgLanta Grown, the local foods promotion program in the Metro Atlanta area. I'm also joined by our assistant program coordinator, Yesenia Maldonado, who is behind the scenes doing monitoring the chat and letting everyone in. We thank you, and I'll pass it on to Tanisio Sinini.
All right, greetings everyone. Hopefully y'all can hear me okay. I'm actually outdoors on my farm multitasking, so thank you for having me. I am the urban agriculture manager of East Point, Georgia by day, and the owner of Nature's Candy Farms all other hours of the day. So glad to be here with you, and I will be co-presenting with Attorney Lester when we get to the second half of tonight's presentation. Thank you.
Hi, everyone. I'm Alex, the CEO of Good Agriculture, and excited to have you all here. I lead a lot of our financial and marketing work, so I will not be leading this webinar, but you may have recognized me from some of the previous webinars.
I'm Kirsten Simmons. I'm the Chief Farming Officer of Good Agriculture, and I also run Ecosystem Farm down in South Atlanta. And the grants funding and financing has been my baby since Alex and I started Good Agriculture. So I'm going to be leading us off tonight. But first, want to take a moment to do our grounding and acknowledgement, and just take half a minute to remember all of the folks that have come through this space and who have been brought down and who we hope to uplift. All right, so we have a few ground rules. These are the same as all of the other webinars. Interrupt me, please. I will get on a tangent, and we have sketched all of this out, but if there are questions that you have, specific examples from your farm, please go ahead and jump in the chat, raise your hand. We would love to hear from you. There is no such thing as a dumb question. If you have the question, chances are someone else in this call also has that question. So feel free to jump in and ask away. So quick icebreaker, and you can raise your hand or answer in the chat. What would you do with an extra $50,000 for your farm?
And for anyone new to Zoom, the raise your hand function is on the bar. If you see where it says reactions, there's an option to raise your hand, and there's also an option to, give a thumbs up or, laugh at something. So feel free to use those as we go along.
I can say for me, an extra $50,000 would go towards securing more of the land around my farm that's currently vacant, because I'm on about 2.5 acres now, and there's roughly 35 that I could potentially get. So that's what I would be doing with an extra $50,000. And I've applied for a few of those grants for that purpose. What about y'all?
We got Leslie in the chat, buy equipment or build a greenhouse. Renee says install irrigation. And Mama Lynn says buy equipment. So it looks like there's a lot of infrastructure investments that would be happening with this money.
Yep. Well, good news is infrastructure is something that's easier to get grant money for if you can believe that. All right.
Anyone having trouble with the chat function? Because we're going to be using this quite a bit as we go through the webinar. And we don't see y'all participating. I will call people. I got another answer from Raven. I would get cattle.
Ooh, that's an interesting one. All right. So I think I accidentally skipped a slide here. We're going to do a broad overview of federal funding opportunities today, different grants, cost shares, reimbursements, guaranteed loans, rental payments. We'll touch briefly on what you need to have for grant funding, other sources of grants other than the federal government. We'll talk about loans from various sources, FSA, ag lenders, traditional banks. We will touch on carbon and ecosystem credits, which is a newer source of financing. And then we will pass over to Kenneth and Tanisio to talk about financing through life insurance, and then swing back around for some additional tools and resources. So our goals for today, at least on our side, we want you to come away from this learning how to fund a new farm or fund a farm expansion, and learning how to become more competitive for grants. And if there's anything else specifically you would like to learn, please toss that in the chat. And if it is possible, we will touch on it. Is there anything in the chat, Alex, that's coming up?
I'm not seeing anything. Oh, we got the first one. Oh, no, this is still some more answers for the icebreaker. So do
Awesome.
goats, dig a well, paying off my truck, paying off the loan I took out from my own bank, and then start a grant sponsoring kid education programs.
Ooh, I like that one. All right, so let's go ahead and tee up our first poll. Go ahead and tell us how you have funded your farm to date. If you're just starting out, you can abstain from this one. Is everyone seeing the poll option here? Got a couple folks going with their own assets. Crowdfunding, other. Loans, all right.
Y'all who are putting other in the, do you mind putting in the chat what the other was? Got a lot of answers for other. I think the FSA people would be very surprised by how this poll is going so far.
Yeah. No, at least one person said they'd pay off a loan. I'm kind of surprised that we're not seeing more loans popping
Oh,
up.
that was Tanisio who said that. And I don't think he's allowed to vote because he's a host.
Yeah, that's fair. Okay.
And we may not get all the participants here since we have some new folks.
Yep. All right. Well, most folks go in with their own assets. I'm also curious to hear what the other, there's 4 folks who said other, so please pop that in the chat. Right. And so today we are going to cover federal programs. So there are several different varieties of federal programs. A grant is the one that everyone loves because you get money up front and you don't have to return it. Oftentimes you do have to report back to the person that gave you that money about how you used it. But it is, with the exception of paying taxes on it, you have that money free and clear. A cost share is when you put money up front and then you're reimbursed with money that you don't have to return. And that reimbursement can either be in part for the expense or in full, depending on the particular program. For rental payments, this is specifically if you are working with conservation goals, you can get money for putting land into conservation. And for those of us saying, well, I'm farming it, I don't want to put it into stasis, there are rental payments that you can get for keeping land in agricultural production. Loans, you get money up front, you do have to pay it back, usually with interest. Equity is when someone buys into your farm's ownership and they then own a portion of your farm. So we'll talk about some of the logistics around that. And then credits is when you get money in exchange for an environmental service. So if you are sequestering carbon, if you are fostering biodiversity, keeping habitat intact for an endangered species, something like that, you can get credits on an open market that get you money for providing that environmental service. So federal programs are, the federal government is the big gorilla in the room when it comes to granting. There's billions of dollars that goes out through the federal government through grants, cost shares, rental payments, and all of this money just got a huge boost through the Inflation Reduction Act. EQIP, for example, and we'll go into more detail as to what EQIP is getting $8.5 billion more than the last calendar year, which was already a record year, through the Inflation Reduction Act. The Conservation Reserve Program is getting another $3 billion. So there is money to be had if you can align yourself with what those granting agencies want. You can get grants to expand on existing projects, expand existing product lines. You can start from scratch with something. You can install or repair infrastructure, conduct research. The trick here is that you have got to align your goals with what the grantors want, or you've got to at least tell them and find a way to shoehorn your goals into what they want. So if they are interested in, say, getting environmentally friendly farming practices adapted on a wider scale, they will give you money to put in infrastructure to adopt environmentally friendly farming practices, but you've got to be able to describe to them what you're doing. The other thing about federal programs is that they are slow. It can take at least minimum 6 months to get funding. We have a grant application pending right now where we applied in December, or no, that was October, sorry, of last year. They're saying it's going to be at least May before they make their decision, and it could be another 6 months after that before we see any of that money. So federal programs, think of them as not entirely unexpected windfalls. You know it's coming, but you cannot depend on them to run your day-to-day business. So there are several big programs that you may have heard of or applied to. EQIP is one that is really common. This is where they're paying you to adopt environmentally friendly farming practices. The Value Add Producers Grant is a really big one where they will match funds to help farmers create value add products. Farm to School is a really popular one where they will help to create create programs that move farm products into schools. Conservation Reserve Program is a rental payment program where they're paying you to keep land in sort of its current state. So either paying to keep it in agriculture, keep it in forest land, grassland, etc. And SARE grants are another really common one that will pay you for conducting research on your farm. So
And
all
hey,
of
Kirsten,
these,
we got a question in the chat.
okay.
Are the grants need-based or just based on alignment? And they are like 90% plus based on alignment. So the nice thing about the federal grants is they are very clear on how these things are scored. So Kirsten will pull up the site in just a minute. But each of these grants, they generally have like a 50-page RFP where somewhere in them they'll tell you what the scoring is. And then they'll have a webinar where they go through, all of these things in detail about that specific grant. Now, some of the grants will have like bonus points in the scoring if you can show a need. So if you're a historically underserved farmer, or you're a beginning farmer, or if you're serving a rural area, sometimes you can get bonus points for those kinds of things. But I have never seen a grant that did any scoring based off like farm income. Although some of these things do have income limits of like, you can't apply to them if your farm generates more than $900,000 in a year. Yeah, so open for, most folks. Yeah, there's some exceptions, again, if you're a really huge farmer.
Yeah. I think the only one that I'm aware of that is specifically for underserved farmers is the socially disadvantaged farming grant. And that one limits applications to folks who have historically been underserved by USDA. So those are some of the big programs that are commonly known. Here are some that you may not know about. Rural Energy for America program. If you're in a rural area, or if you are a sole proprietor farmer, you can get cost shares and reimbursements for installing energy efficient equipment, solar panels, geothermal, etc. Urban Agriculture Innovation Grant. This one funds research for innovative agricultural techniques in urban areas. Supplemental and Alternative Crops funds research into anything that USDA considers alternative, which is a lot of things that we would consider basic, like vegetables. Climate Smart Agriculture Activity funds adoption of climate smart agriculture infrastructure. Conservation Innovation Grants is one that funds, it's past the research phase, but is, looking at how do you roll out conservation concepts onto larger and larger farming areas, I guess that would be the best way to put it. So point being, there is a lot out there, a lot of money out there. And you kind of feel like you're being pulled in 10,000 directions when you're reading all of the opportunities. But if you see something that comes close to what you're already doing, it's worth the effort to try to fit yourself into what other folks want to give you money for. So
we got another question in the chat.
Okay.
Are there particular programs that don't get much interest or are less competitive? The ones I've heard, so the SARE grants, they have told us they struggle to get quality applications because they're really looking for it to be like a research project, and they basically get a lot of applications from farmers who are like, I want to, try this breed of cow, so I'm going to just buy this cow and like not have a control group, and that's not something that they can really fund. And then the other one we've heard is for EQIP and CSP, because they are getting so much more funding, they're worried about being able to get enough quality applicants, especially, smaller farmers who, may not have heard of it before, and making sure all the money doesn't get sucked up by the bigger farmers with more resources.
Yeah. And one thing to mention with EQIP, like EQIP is strongly predicated upon having a relationship with your NRCS officer. Each county has its own representative, and one of the best things you can do is Google NRCS agent my county, and reach out. Start that conversation and have them, let them be aware of who you are, what you're doing. The quality of NRCS agents varies widely. That's actually an issue that NRCS is really working on. So if your county rep is not represented or is not responsive to you, feel free to reach out to the regional office, reach out to the state office, reach out to us at Good Agriculture or AgLanta. We can try to pull some strings behind the scenes and get you the response that you need. So we're going to do a quick quiz of what are some of the things that EQIP covers. Who thinks EQIP can cover a well?
And drop your answers in the chat. Renee raised a hand, I think. I saw the hand disappear, so that may have been a fake hand.
I was responding to the quiz.
So was that a yes hand?
Yep.
All right, we're getting a lot of yeses in the chat.
All right, you are all correct. How about a perimeter fence?
Got an answer for no. Got an answer for yes. Maybe. Eddie K, no. This one's a little bit harder. Yes. I would think not. Yes. This may be the most divided we've ever had folks on a quiz question.
Well, the trick here is to know that EQIP wants you to have already been farming in a space, and that they want to fund things that are supporting environmentally friendly farming. So they will not fund a perimeter fence. However, will they fund a cross fence?
I see some of y'all are dropping things into the chat here that may come up later in the quiz. So Heather, when we put up her first response was cross fencing. We're getting a lot of yeses in the chat on this one.
Yep. And y'all are right, because cross fencing can be used for rotational grazing, which is a environmentally friendly farming practice. So if you've got the perimeter fence and you have stock, they will pay for cross fencing. All right, what about drip irrigation?
Getting some yeses, one no, lots of yeses. Got a yes in all caps from
Yep.
Justin.
How about overhead irrigation?
We got one no, a maybe, no, no, no overhead.
Yep, you are correct. All right, how about a barn?
No, yes, no. I think the point to make while we're doing this quiz is the EQIP website is not super clear about what they do and do not cover. So again, a good first step is to go talk to your NRCS agent and just let them know, here's everything I want to do, and let them tell you which things they will and will not cover, because it is not necessarily the most intuitive thing. Yeah. The barn is really dividing people. We got a lot of yeses, a lot of nos. And I think some people are abstaining.
The thing with the barn is that there are a lot of programs that NRCS runs and USDA runs that seem like they would overlap with each other. So in this case, a barn will not be covered by EQIP, but would be covered by a farm storage facility loan. What about a high tunnel?
We got a bunch of yeses.
Yeah, this one's easier.
Yeah, and that one actually is on their website, which is helpful.
Yeah. What if you are planting trees that you are not going to harvest?
Yes, no, yes. Yes, no. Yes.
So they will cover this one because if you're putting trees, say, in a riparian buffer or in a pollinator habitat, that is environmentally friendly. That being said, how about planting fruit or nut trees?
Got a no. Yes. Yes. No. Yes. Yeah, so we got a divided crowd on this one too. Why
Yeah.
not? Why not? Yes.
Why not? Well, they're not going to give you a direct way to make money, basically, is what it comes down to. You know, they're not going to buy, even though fruit and nut trees may be beneficial to the environment, they are not going to buy them in the same way that they will help you with the infrastructure for rotational grazing, but they will not buy your cattle or goats or pigs or whatever you're grazing for you. All right, what about cover crops?
Yes. Yes. IDK. Yes. 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 Lots of yeses.
You are right on that one. What about planting vegetables?
No. No, 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 no.
Correct. What about planting a pollinator garden? I may have given this one away already.
Yes, 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 yes. We got some unanimous yeses on this one.
Yep.
I think we may also want to just send that recording to NRCS, be like, hey, put this on your website.
Exactly.
Make it a little easier for folks.
Yeah. All right. We are going to do a quick live demo of the grants.gov website. And you also get to see all of the crazy stuff that I have in my computer, because that was not how it was originally planned. So this is grants.gov. This is where you go to look for any federal grant, period. Super simple. Search grants. Personally, I usually just click agriculture right here. It's 94 grants. Now, if you're looking at this, there is an incredible variety of things that you will see when this comes up. And you are not going to be eligible for all of them. There are a bunch of them that will never even be remotely applicable to you. So say, for example, the faculty exchange program for Philippine and Vietnamese veterinary science. Say that 5 times fast. Clearly has nothing to do with farmers in the US. You'll also see things like Alabama NRCS outreach and education. So if we click on this one, we're, as a small business, potentially eligible to apply for this, assuming that we are in Alabama and not Georgia. But you scroll down, you get the description of the grant, and you start to get an idea of like, what is this for? You know, so for Alabama, they're saying that they're going to put $600,000 to solicit partnerships to help enhance the implementation of key outreach projects for the fiscal year of 2023. And let's say you're interested in this. Go ahead and download Is it actually going to open? There we go. And we have roughly 20 something pages on exactly what the dates are, what the federal, floor and ceiling, the minimum opportunity is 10,000, maximum is 60,000. Got a program description. They tell you exactly how they're going to grade it. You can get just about everything you need off of grants.gov. And the most important thing you can get that you need is the contact info for the person that is overseeing this, or the office that's overseeing this, because since it's the federal government, there will be things that are confusing. And you are probably going to want to reach out and ask questions.
We got a couple of questions in the chat. So one, can you give the name of the grant that covers barns? And it's not a grant, but that's called the Farm Storage and Facilities Loan, which again is not a grant, it is a loan, but it has a low interest rate. So it's usually, half or less than the interest rate you could get from a regular bank. And then the second one was, does the federal government fund outreach at all, particularly urban ag to school age kids? And I think there's a ton of those kinds of things, but the biggest one is probably farm to school.
Yep. Yeah. So I have a tab that's constantly open on my computer that is set to this page, like all of the grants that are in agriculture. And whenever something new comes up, I just go check it out and see, is this something that I think is going to be worth actually applying for? Is it something that is new to our grants database? Is it something that might match some of the people and farmers that we work with? Is it something that matches what we do at Good Agriculture, or that what we do with our partners like AgLanta and East Point Grown?
And at the end, we will share some resources that help curate this, so you don't have to live on grants.gov like Kirsten does.
Yeah, I live on grants.gov, so you don't have to. Let's see. Where's my mouse? There's my mouse. All right. So cost matching. There are very few federal government grants that do not require some form of cost match. And that is where you provide some level of funding and the grantor matches them. Generally, the federal government will cover anywhere between 50 to 90% of the project. And then your cost matches the remaining amount. So for value add production grant, they require that you put up 50% of the project and they put up the other 50%. For something like the conservation innovation grant, that one is a 66 or 67-33 split, where they cover 67 and you cover 33. For equip, it is 70 to 90%, depending on it. We mentioned earlier that it depends to some extent on whether you fall into certain populations. If you are a beginning farmer or an underserved farmer, you're eligible for up to 90% of cost match. If you are a white male farmer who's been farming for 15 years, then you're down in the 60 to 70% range. All right. So we have another quick quiz. What are some valid cost matches? You think the value of your time and labor is a valid cost match? Go ahead and toss your answers in the chat.
Got several no's. No, 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 no. Yes. 2 yeses, like 5 or 6 no's.
Yes. It depends on the grant, and sometimes the grant will specify that you can only use a certain percentage of your cost match as value of time or labor, but you can definitely value your time and your effort as part of the cost match. What about farm volunteer time and labor?
This was probably especially pertinent for folks who have community gardens or other nonprofit efforts. We got a no, we got a yes. No. Yes. Yes. Oh, this is a good question. If it's a volunteer, where is the cost? So Leslie, the argument here would be, you put in a volunteer and you put in the value of what you would have had to pay somebody if you'd had to hire someone to do that. We got one more no. Wait, did you? Oh, did the animation not show up?
Oh, I think you talked over it.
Okay, the answer was yes on the
The
volunteer
answer was
one,
yes,
in case
yeah.
that wasn't clear.
What about equipment that you already have?
Got one no. Another no. Not getting a lot of answers on this one. This one has to be hard. We got a couple yeses. Got another no.
All right, this one is no with an asterisk because the answer is normally no, but sometimes if the equipment is core to your proposal, you can get permission to have equipment as a valid cost match. And that brings up a really good point that, talk to the agency, ask them questions. They're paid with our tax dollars. Make them answer. Farm infrastructure that you already have.
We got a no/yes. No. Talk to the agent. Good answer. Yes. Got
You're
another yes.
learning. I like this. Same answer. Usually no, but if it's core to the proposal, you can sometimes get an exception.
And Leslie asked, how does one set a value for all of this? The equipment or the structure? So normally the easiest way to do it is, the price you would have to pay to buy it if you needed to buy it this year. So if you're writing a grant that requires like maybe you're doing like a no-till thing and you need to buy like a specific no-till drill, you would just basically, go online and get a price quote for what that would cost, and that's the cost you would put into the grant.
All right. What about supplies that you already have?
Got a no and a yes. Got another no. We also got a question, how do we reach an NRCS agent?
So best way to reach an NRCS agent is first figure out who your agent is. If you Google NRCS agent and your county name, you should get a name and either an email or a phone number. That's the best way to reach out.
Yeah, that actually is on their website, which is helpful.
Yeah. So for supplies you already have, the answer is yes. How about seeds that you saved rather than bought?
Got a no. This one seems to be stumping people.
This
Yeah.
one is yes.
One answer for no.
Generally, if you are going to have to buy something that you already have, you can use that as a cost match. How about donated supplies?
Got several yeses on this one.
Yep, the yeses have it. How about borrowed supplies?
Got one yes, more yeses, and one no. Multiple yeses and a no.
Yep, the yeses are correct. Compost that you made rather than bought.
Yes, 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 yes. Lots of yeses.
You're correct.
Yeah, we've actually used that one on the grant we referred to that we're still waiting on from October.
Yep. Though if they keep delaying the announcement of said grant, we may end up buying it in the end. We'll have time to make it. What about food that you feed yourself during the project?
No, 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 no. One yes.
No's have it. All right.
Yeah, so there's lots of ways to solve the cost match piece of this,
Yep.
even if you don't have a ton of cash.
Yep. So rental programs, most rental programs fall under a conservation program umbrella. There are dozens of conservation programs, including to the point that sometimes even the NRCS agents have to go look up which one is applicable to various situations. But basically with rental programs, the government is paying you to implement conservation practices on your farm and then paying you to keep those practices and ecosystems in place. So this is, taking wetlands out of production and restoring the marsh ecosystem. This is using rotational grazing on your farm and continuing to keep those rotations going. This is getting rid of invasives in your forested land and helping to make sure that those forests stay healthy. Like I said, there are dozens of these. You do have to own the land for most of them. But if you own land that has any sort of habitat on it that would be of value in a conservation sense, then you should look at conservation programs. Outside of the federal government, a lot of state and local governments will do their own local grants. So the state gets money for its own conservation innovation grant with its own focus from the federal government. There are county level grants. Last year, for example, Fulton County decided that they were going to give out $6,000 to any farm within Fulton County limits. No questions asked. There are nonprofits, Georgia Organics, Foodwell Alliance, American Farmland Trust, National Young Farmers Coalition. There are foundations that will give out grants, things like the Kaiser Foundation, American Heart Association, the Gates Foundation. Often for foundations, there's a lot of competition for open calls, but if you are able to build relationships with those foundations, you can get funding without having to compete. So look for foundations, especially if you have a mission in addition to simply growing food. Look for foundations who have funded projects that are similar to yours or have missions that are similar to yours. Use LinkedIn and use your network. Find an introduction to someone who works at that foundation and just open a conversation about, what is their mission? Where are they spending their money? Whether or not your farm may be a match for that. And then if you get to the point where they're asking you to submit a proposal, then you need to customize that ask to their goals. Anybody who's gonna give you money is going to do it for their own purposes. And so for you to get that money, you need to be able to match what their purposes are. And then
just to double stomp on that one. So these guys are not going to be as transparent as the federal government about how their own internal scoring works. So really go on their website, see what words they use for stuff. What do they say are their priorities, and make sure you put those same things in your proposal. So if they say, we tackle food insecurity and your mission is, we help, reduce food deserts. Well, you should just call it food insecurity. And you should use their language. That'll improve your chances.
Yeah. Incubator programs. These are an awesome way to get education. They may or may not come with funding, but if they do come with funding, then that's extra funding for your farm. So there are specific farm incubator programs through Global Growers, Truly Living Well, Metro Atlanta Urban Farm. There's the Williams Farm Incubator Program out near Athens, Journeyman Farmer Program through the Georgia Extension. Georgia Organics has an accelerator. If you're looking for general business education, so the farm incubator programs will sometimes provide funding, but will provide you with a foundation in how to grow food. And sometimes, if you're lucky, a foundation in how to run a farm business. If you're looking for more general business advice, look for a more general incubator. So something like Start Me through Emory. The Center for Civic Innovation has some good ones. Look for programs that are trying to fund the type of farm that you want to create. So loans. We're going to do a basic how to borrow money successfully, which is really just going to be a list of all of the mistakes that I made with borrowing money. So when I first started my farm, I had debt from another business, and being me, figured I was going to clear that debt to give my farm a chance to thrive, and put all of my effort towards building my farm's credit score, only to realize that the banks really do not look at your business credit score until you're huge. When you are a small business, your credit score is your business's credit score. A credit score is a way to estimate for the bank how likely you are to pay the loan back, and it's based on your history and income. So if you are going to look at loans, you need to have a solid credit score, which means you have to have solid personal finances. You need to have a business case, you need to have plans, and they need to be fleshed out. There's Alex and I have a bit of a disagreement over this one. Like, having a relationship with your banker is something that banks will say a lot. Personally, I have never had my relationship with my bank be something that was beneficial to me when my farm was in a financial pinch. And the theory is that if you have a relationship with the institution, then they can make informed decisions on a loan if you're otherwise a borderline decision. Personally, I think that if you have a solid credit score and off-farm income, that relationship is way less important. But that being said, if you have a loan through a bank and you know that there are problems coming up, reach out in advance and see if they'll work with you. I've never had that experience where they would work with me, but your experience may be different than mine.
The other thing I want to highlight here is, especially given the results of the first poll where no one had funded their farm using loans. A loan is not something to be afraid of. The reason why loans exist is to help new businesses and new ventures get started. And we're going to be talking a lot more about business plans at our webinar in 2 weeks from now. And the business plan is not just there to make the person making the loan feel better about your business. It's also to make you feel better about your business and really have a good understanding of what is the risk you're taking. Is your business going to be able to, thrive and pay back the loan, like even if some negative things happen? So we'll talk about that more in a couple weeks.
So there are several different sources of loans. If you go to, given where you go, you're going to get a different reception. If you go to a traditional bank, most of them do not know what to do with a farm, and they'll probably give you a personal loan, but they'll assume that you're never going to make money as a farmer. If you go to an agricultural lender, you'll get a much different reception because they understand how farming works as a business. So places like the Georgia Development Authority, Farm Credit Bureau, Ag America, Ag South, Mad Capital, you can get a better reception coming to them with a farm business plan and your plans for how you're going to run your farm. The Farm Service Agency is a federal agency that can either act as a lender or as a guarantor. So their goal is to try to make funding available to farmers who can't get credit elsewhere, or to push the farmers that are borderline over that edge so that they can get credit elsewhere. They like this to be a temporary thing. They don't really want you to be on FSA loans for more than 7 years or so. And then they will offer land and operating loans. If they're operating as a lender, then they will actually fund the entirety of that loan. If they're operating as a guarantor, they'll go to the Farm Credit Bureau or Ag Georgia and say, you know, we would like to guarantee this loan so that if Kirsten Simmons defaults on it, the Farm Service Agency will come step in and make sure that Ag Georgia remains solvent. That being said, you do have to have a credit record. And I learned this the hard way because I was planning on taking out an FSA loan when my farm had to move in 2020. And remember when I mentioned that I focused on my business's credit, only to realize that they don't look at my business's credit. I had declared bankruptcy in 2016. I wiped the credit that I had. And then I was like, all right, I'm not doing well with credit cards and other, sources of short-term loans. So I'm just going to go cash only. I'm going to focus on building my farm's credit. And when the Farm Service Agency pulled my credit report to see if they could give me a loan, they said no, because there was nothing on my credit report. So I guess moral of the story is that you have to play the game and know that you need to actually build a credit report. So. Crowdfunding. There were some folks that mentioned that they had done crowdfunding for their farm. This is, if you have a strong network, this is great. The simplest form of it, if you're doing like a Kickstarter, Barn Raiser, Indiegogo, is just run your campaign, you get cash back. The absolute simplest form is accepting gifts or loans from your family and friends. There's also options for crowdfunded loans, which is what I ended up doing after I was rejected by the FSA. So it's a combination of lending and crowdfunding where you are tapping your network to raise money that you then pay back through the company that you're doing the loan with. So I went with Steward. It has been mostly a good relationship. They are definitely way more understanding than a typical lender would be when I've run into issues. And I have the extra incentive to make sure that I repay that, even if I'm doing it from off-farm income, because that's my community. I can go pull up a list of all of the people that put money towards my farm infrastructure loan. So this is an option if you have a solid network that you can pull from, and you have got to market it.
Yeah.
Go ahead, Alex.
We got a question from Justin. If we can transition to Kenneth in 7 minutes.
I believe we can do that. We have 3 slides left. All right. So, credit cards. If you have good credit and you can stay on top of them, credit cards can be a great way to build a farm. It is a free loan for a month. It helps you build credit. Again, if you have good credit, you can pass balances around on promotional rates and pay a very low interest rate. The bad is that it is really easy to lose control of this. Like, you have got to be on top, sit down on a weekly basis, keep track of what you're spending, know when your interest rates expire. If you have promotional interest rates, make sure you're moving stuff around. And if you are not on a promotional interest rate, you have got to pay that thing off each month, because the interest rates are stupidly high, like 20 to 30% high. You will pay an enormous amount extra to the credit card company if you can't stay on top of using credit cards to fund your farm.
There's also a personal finance myth that's out there of you need to carry a balance on your credit card to build credit, and that is false. The best way to build credit is to take out a credit card and pay it off in full every month. So there's never a reason to carry balance on your credit card. Or never a, good financial reason to.
Yeah. Equity financing. This is an interesting one. Again, enter with caution, similar to a credit card. You are basically selling a portion of your company to someone else. And that person potentially has the ability to have a say over how you run your business. If you're going to do this, you have to make sure that you find investors who are aligned with you and your mission. Never give up more than half of the ownership of your company, and involve a lawyer early on, because this can get really messy. I funded the initial iteration of Ecosystem Farm back in 2016 with equity financing, and I made every mistake in the book. And I got lucky, to be perfectly honest. I sold 75% of the company. I had investors that had conflicting motivations. We had to force out 2 people out of the company within the first 6 months. I just got lucky that the majority of the investors were more aligned with me than they were with the other folks on the ground. So this is, if you are looking at doing equity financing to raise money for your farm, talk to other people, involve a lawyer, and really proceed with caution. If you've got the right team, it can be great. If you don't have the right team, it can be a nightmare where your rogue investors record you without your knowledge and insist on getting double their return in 6 months out of a farm. And the last thing we are going to cover briefly before we pass over to Kenneth is carbon and ecosystem credits. This is a fairly new funding mechanism where someone pays you to create an environmental benefit that then offsets their environmental degradation. So today, carbon credits are best known for larger acreages. Generally, you have to have at least 250 acres to make it worth the effort. But that's dropping pretty quick. We talked with a company a couple of weeks ago that's testing out a methodology for roughly 25 to 50 acres. And this is like, Delta says that they want to be carbon zero or net zero. So they want to offset the jet fuel that they burn. They will pay you to rotationally graze, to plant trees, to do things that suck carbon out of the atmosphere and offset the jet fuel that they burn. So right now, this is something that's not quite here yet for smaller farmers, but within the next 3 to 5 years, there should be credits for carbon credits on small farms, water quality credits, biodiversity credits. This is how large companies are offsetting the impact that they have on the world. So is something that you should keep an eye on and could be a way to bring in extra money. And with that, I am going to stop sharing, and I can see my mouse. There's my mouse.
Did anyone have questions on anything we've covered before we switch topics a little bit here? We'll also pause again for questions at the end. I think folks are pretty good at asking the questions along the way, so I guess we'll hand it over to Kenneth.
Well, good evening, everyone. Thankful to be on the call and be able to share and listen in with the group. Hopefully I can bring some value added as well to everyone. Let me share my screen here. And Tanisio, please jump in, ask questions as I go, because you kind of know where I'm going with this. So let me All right, once again, I'm Kenneth Lester. I'm the IBC practitioner here. Any information I'm providing or sharing is not specific tax or legal advice, and this is my disclaimer here. You're encouraged to seek your own advice from your own tax or legal counsel. My first suggestion would be to read the book by R. Nelson Nash, Becoming Your Own Banker, Unlock the Infinite Banking Concept. The book is not about investments of any kind. It's about how one finances the things of life, which certainly can include investments. It's not about a race of return. The book is really a text for a 10-hour course of instruction about the power of dividend paying whole life insurance. The book demonstrates that your need for finance during your lifetime is much greater than your need for protection, even though it's based on life insurance. It's really about how one finances everything in life, in buying and selling and transacting. Well, in the late 1970s, Nelson was making money in the real estate business, buying land, using leverage, using other people's money, which says buy some real estate, borrow the money to pay for it, because you're always dealing with other people's money, and borrow money. You either borrow money and pay interest, or use your own money and give up the interest that you could have earned. So you pay interest for a little while, then you sell the property. And all you've given up during this time period is the interest that you have paid. That is when the lever on the leverage seesaw is going the right way, and that's wonderful. Prime at the time in the late 70s was 8%, and he was required to pay prime plus 1.5%. He became accustomed to paying approximately 9.5% of interest. Since everything was going smoothly, he does what anybody else would have done. He scaled up, bought more land with leverage, of course, and this kept working because the market was rising. However, the financial geniuses, kind of like in today's world, never tell you what happens when the lever goes the other way. Kind of like what happens when the interest rates jump up. And what happened was interest rates in 1981 went up from 9.5. By 1981, they were 21.5%. So he had become accustomed to paying a rate of 9.5%. So now he was due paying 23%. Hold on one second. So at the time, he owed the banks a $500,000 loan, which in today's dollars is about 1.6 million when you add in inflation. And at 23%, that meant his interest payments at the time would be $368,000 a year. At 9.5, which he was accustomed to paying, is $152,000 a year. So his interest rate and what he was due to pay the banks more than doubled over like a two-year span. So in 1981, $500,000 debt at 23% interest rate. This is financial bad news for him. He was in trouble. The banks, started calling the loan. They wanted him to pay. Of course, the geniuses will tell you, kind of like today, well, you can always sell if the price is low enough, but who wants to do that? You're taking a huge loss. So after many nights at 3 and 4 in the morning on his knees in prayer, the idea came to him. The basic idea was born over many nights in prayer. He asked the Lord, hey, help show me a way to find my way out of this financial nightmare that I have created for myself. So he was taking responsibility. He didn't say anybody else created this nightmare. He took it on to himself, but he was praying for help. And then he said his answer came back to him. You're standing in the middle of this, in the midst of this, everything it takes to get out, but you don't see it because you look at it like everyone else. So he had to rethink his thinking. He had to reframe the way he was looking at things and what to do, not following what everyone else was telling him to do, what traditional financial wisdom was doing. So IBC was born out of that. It's a concept and thought process of how we take control of the banking function in our life.
just can't.
Well, what is the problem? Is it the need for money? Is it the accumulation problem? Or is it because we focus on the wrong thing? Is it a mindset, chasing a higher rate of return? Well, the infinite banking concept, it's not about rate of return. It's about controlling the environment in which you operate. So many people don't know what to do with their money. Why? Is it conditioned thinking or a lack of knowledge? Is it because every commercial you see is about put your money here in this pool and we'll get you this rate of return? It's the fallen financial geniuses. Well, think about the farm to table, kind of like farming. If you understand what it costs, the cost involved in production and farming the food or ranching the cattle, and you understand how to control the supply chain, you understand the quality of food and the pricing. So think about that with banking and financing. Put your family first, be the lender, be the bank. Additional book would be Farming Without the Bank by Mary Jo Ehrman. Nelson put in his book, he quoted from the Bible, "My people are destroyed because of a lack of knowledge. I reject you from serving as my priest, since you've forgotten the law of your God. I'll also forget your sons." When Jesus saw him lying there in John 5:6, when Jesus saw him lying there and realized he had already been there a long time, he said to him, "Do you want to get well?" Nelson took ownership of his financial problem. He was able to get access to money through 3 life insurance policies that he had at the time that had cash value, and he was able to obtain policy loans. The policy loan interest rates on these 3 policies were between 5 to 8%. Now, mind you, prime was 21.5. So he's already, I won't say winning, but he's in a better position already at this point. This helped him with the financial pressure. This helped him alleviate and pay off some of those loans and pay down some of those loans. It became evident to Nelson at this time that he needed to dramatically increase his life insurance premiums to create a bigger pool of cash values to borrow against and pay out the bankers. With a little honest introspection, it revealed to him he could revise his spending pattern. This was a starting place. It was opposite from what all the experts had said to him. Are we thinking like consumers or business people when it comes to our money? What value or do you see or see in your money, or do you see it value in generating income? Do you look at your money as a pond or river? A pond will be just accumulation where taxes, fees, and inflation just eat it up. Or do you look at it as a river? Basically where it flows and you're able to create more income. Banking, finance is a business that we're in, whether we know it or not, or whether we recognize it or not. Loans from banks, as mentioned earlier, requires the application process, requires timing, requires contracts that you usually don't write, and they usually determine when and how the money is paid back. How is your money flowing? Is it flowing downhill like a waterfall, or be retained like a retention pond? Have you been taught to take control of the banking function in your life? I spent my whole life unlearning the things that I found out not to be true. 5% of the people think, 10% of the people think they think, and the other 85% would rather die than think. Look at the lines here. An inconvenient truth or a reassuring lie. Well, let's pop in some of the poll questions that we have. Do you know who else uses life insurance policies for business purposes? We got 1 no, 2 no's. Okay, we got 6 out of 6, all no's. All right. Let's move ahead on the poll. Do you know who else? Okay, 7 out of 7. I think we got some more coming in. All right, can we go to the next question? I'm gonna tell you in a second who else uses it. Can we go next question? Okay, from your bank, are you able to get a loan in less than 15 business days? All right, looks like we got no's again. All right, let's go to the next one. Are you able to control the installment loan payback terms to your bank on the loan that you are required that you do obtain? All right. Well, let me ask Tanisio a question. Tanisio, are you with me?
Yes, sir.
It's my understanding that you have a cash value whole life insurance policy. Is that correct?
Yes, sir. That's correct.
Have you ever had the opportunity to take a loan from the insurance company?
I have, yes.
Can you briefly tell us how that went with the process and how long it took to get the loan?
So basically, I set up my policy about 1.5 years ago, and with the plan of using it as a bank. And then within the, I think, 13th month, I decided that I wanted to make a major purchase, and called up the insurance company, basically let them know that I wanted to take out a loan against my policy.
Okay.
And then that took roughly, I think it was 10 days for the money to come down, and that was actually due to a mishap on my end. So it actually could have taken as quickly as 7 days for the loan to arrive.
Did they ask you what you needed a loan for?
No,
Did they actually fill out an actual paperwork of how much income you had coming in?
no income and no credit check.
All
Actually,
right.
no questions asked, actually.
Right. So was it a easy experience for you, a pleasurable experience?
Extremely easy, yes, sir.
So I guess that means you, and that's in comparison to, have you ever had to obtain a loan from a bank?
The only loans that I've attempted to do were for mortgages, for
Okay.
home, well, mortgages, cars, and
Right.
then definitely credit cards, but never one for a business, but definitely for those two major purchases, the home and the car.
Right. And for those purchases, they require a little more information than you just calling in and asking for money for a loan, correct?
Certainly, most certainly. And I've definitely got some denials.
All right. All right. Thank you. I'm gonna
Yes, sir.
move ahead here. Can we drop the poll from the screen? 1 second. Okay, there we go. It's 3 methods of financing. 1, use credit. You borrow, then you pay back, borrow, pay back, borrow, pay back, borrow, and pay back. The next is it's called the saver. And the saver pays cash, buys, pays back, empties the tanks, buys, paybacks, empty the tank. Or a third way is a wealth creator or a value creator using the family private banking, wherein you save, and over time, by using other people's money, you pay back and you get above that zero line. Here's another way to look at it right here. The debtor works to spend. The saver saves to avoid paying interest. The wealth creator saves and uses other people's money to maximize efficiency. I'm gonna go over it one more time in this chart here to make it a little bit more, try to focus in, because this is actually one of the most important things. A debtor buys immediately, no savings, earns no interest, but pays interest, borrows money from a lender at the highest market rates using future earnings or future earning potential as collateral. The saver, a little bit better position, saves first, has the patience to save first, earns interest on the savings, pays cash, which is also called self-financing, borrows money from himself, reducing the collateral position, resets compounding, so he empties the tank, makes payments to self to get back to where they were before the purchase, giving up the interest their money would have earned emptying the tank. What's the difference? Both of them end up at the zero line at the end. Well, there's an alternative, and this is the infinite banking concept. By being your own private banker and using other people's money, you're able to buy, well, you save first, Then you buy compounds to interest. It collateralizes the purchases. The borrow from a lender at a negotiated rate or insurance company like Tenicio did. You pay back the interest to the insurance company, and your money and your policy continues to grow, compounding year after year, uninterrupted. Let that sink in for a while. You see that line going up, so it takes time before you make that first purchase. Yeah, the first one, you'll be below the zero line, but eventually, as you pay back, the next time you borrow, you're below a little bit, emptying the tank, but you never empty the tank all the way. And eventually you get above the zero line and you never look back. It's called compounded interest over time. And that's kind of position A. That's the position that you want to eventually get into. And that's called the wealth creator position. IVC is fundamentally about banking. That's the B in the title. The process is controlling of the banking function of your family. It's better than traditional banking. And the platform that is used is a properly structured whole life dividend paying whole life insurance contract policy. Will you spend the time creating one of the best businesses in the world? Best passive cash flow businesses in the world. Why life insurance? Well, you get death benefit, you build cash value, and wealth creation. In the event that you die before you pay back the loan or prematurely or before you want to, there's a death benefit that goes to where you would like any beneficiary or any organization or where you would like it to go. Who else uses life insurance? It's called BOLI, Bank-Owned Life Insurance. This was reported in December 2022. Bank of America. It's at 24 billion. Wells Fargo, 19.45 billion. JP Morgan Chase Bank, 12 billion. PNC Bank, 10.6 billion. Truist Bank, 7.5 billion. US Bank, 7.3 billion. Citibank, 5.29 billion. And I looked up this morning, just to get after what happened with Silicon Valley Bank, I wanted to see how much life insurance they had on their capital assets. It wasn't much at all. It was 77 million. And their total asset was 209 billion, and they failed. Why do they have this? Well, they use tier 1 capital as one of the strongest capitals, and all banks require to have some reserves, and the bank's equity capital and reserves determines the bank's financial strength. So they're required to have this against risk. Banks retail financial products such as checking and savings accounts, CDs, credit cards, and mutual funds. But if you walk into a bank and try to put your money where the bank puts much of theirs, you won't be able to. Banks don't sell the same financial assets they utilize to protect themselves from unexpected loss, holding, grow cash reserves, prepare for an unpredictable future, avoid taxes on gains and windfalls, or keep pace with rising costs. And fund employee benefit programs. Whole life insurance benefits: 1, death benefit; 2, tax deferred growth; 3, tax favored distributions. There's certain situations where the money continues to grow in there, the cash value, and you're able to get distributions later on and never pay taxes on it. Competitive return, high contributions, meaning you can put as much as you can in them. There's no restriction like on 401s, like annual IRS restrictions. Collateral opportunities, the opportunity to leverage against it, a safe harbor, no loss provisions, guaranteed loan options, and unstructured loan payments. And very important is liquidity, use, and control of your money. The problem, you finance everything. You either borrow money and pay interest, or you use your own and give up the interest that you could have earned. The problem is that all these are financed by another banking organization. What is the most efficient way to financing without having to give up control of my money? That's what the IBC concept is about. The infinite banking concept is about. It's about finding the most efficient way to financing without having to give up control of your money as it continues to grow, and you're being an honest banker and paying back the loans along the way. It requires you to capitalize, pay premiums into it, borrow against it, and it grows over time. It will take the average person at least anywhere from 10 to 20 years to build a banking financing system through life insurance to accommodate all their needs for financing their auto, houses, etc. Not just some, but all. Once established, it can be passed down on future generations, so as long as they are taught the system of how to work and suppress their basic instincts to go back out the back door of the grocery store, so to speak, or steal the peas. He talks about owning a grocery store in the book and what to charge yourself. You don't give yourself a discount. You pay market rate, because otherwise your business is destined to fail. You can't run a business and give yourself discounts along the way. You got to be an honest banker. Banking is the most important business in the world. Think transactions, think platforms, PayPal, Coinbase, Wall Street, banks, credit cards. Whenever a business transaction takes place, money must flow from one part to another in a relatively short amount of time, or otherwise nothing takes place. That flow of money must come from a supply source or a reservoir. Why don't you build your own reservoir so you don't have to have the discussions with the bank? You make that call, or on some of the insurance companies, you can do it online. You can request a loan online and it can be in your account in less than 10 to 15 days. The essence of what the banking business is all about: someone or some organization has control of a pool of money and must flow, and it must flow at a cost to meet some need. So why not get some of that cost going into your own banking, in your own reservoir, in your own where your death benefit continues to grow and your cash value continues to grow, and it goes in one direction. It's not tied to a stock market, so it doesn't go up and down. You don't have to. You can sleep at night. You know it's building. Every month it's building. So I'm here to help others. If you reach me afterwards, to create your own banking system so that you control 100% of your needs by becoming your own banker.
And we definitely want to make sure, because I know there's probably a lot of specific questions regarding this system, that we do take questions now, but also I highly stress that you all consider looking at those two books that Attorney Lester mentioned. Both of them are only about 100 pages long.
Right, here's the first.
Is invaluable.
Here's the other book besides Becoming Your Own Banker. It's Farming Without the Bank by Mary Jo Ehrman.
Your screen's on blurry mode. Here, I'll hold mine up, Kenneth, because I actually happen to have mine too. So,
okay.
And then actually, hold on, the lighting is a little bright. And if I may, Attorney Lester, I want to share with the group actually why you were brought to the table.
Okay.
So for those of you all who've known of my works as an advocate in farming, I used to work for Georgia Organics. And at the time when I was working for Georgia Organics, this book had actually come out. It was advertised on Facebook and I purchased it. And then shortly after purchasing the book, the author of the book, Mary Jo Ehrman, who's also an insurance agent, who's authorized to offer the infinite banking concept, she did a conference about farming without the bank. And so I attended that conference in 2016 and actually got a chance to see R. Nelson Nash speak. It was the last public presentation he did before he passed away. And so having that opportunity to be in a room with farmers from the breadbasket, we're talking about farmers that small scale farming for them is 500 acres. Average size, I'm just going to guesstimate in the room, we're probably 500 to 5,000 acre farms. So that is still small scale farming, believe it or not, y'all. When you start to get above 5,000, that's when you get into what we'll call like large scale farming. But all of that being said, these farmers were tired of having to always take out loans from the banks and then pay them back with no real benefit except just the revenue that they may have made off of the purchases they used those loans for. So what the book is teaching these farmers how to do is to reduce their debt load year by year. So let's say the first year you had to take out, and I'll use numbers more relative to our size in this community. Let's say you had to take out a $5,000 to $10,000 loan. And then you use that to maybe use as a down payment or purchase, a Kubota tractor or BCS or something like that, right? And you're expecting that the addition of that tractor to your business is going to allow you to generate more product, increase your sales, and make more money. And then the goal, of course, is with that money that you've made to pay that tractor off. Well, let's just say that the item that you're having to purchase, instead of it being that one-time purchase, is something you have to do annually, like seeds. Some of these larger scale farms, that's the kind of things they're taking out loans for. So they're having to do that annually. And still keeping that $10,000 in mind, let's say it was $10,000 in seeds, you pay it back through the revenue you make, but then you just go back to the same bank every year and you keep getting that same loan. You never actually reduce your dependency on that bank, because you have to keep going back to them every year. By using IBC, what ends up happening is you might start off at $10,000 the first year, but then you're also shifting money away from that bank into your bank. And so now by year 2, let's say you're only taking out $8,000, because now you can supplement the other $2,000 with your bank. Then by year 3, you might only be taking out $6,000. By year 4, you might only be taking out $4,000. By year 5, you get the point. You're starting to reduce your debt load on the bank, and instead you're shifting it over to your life insurance policy. And now you're taking out loans from your own bank, and you're paying yourself back the same interest you would have paid a bank. So thinking about the time that Kenneth Lester was talking about with R. Nelson Nash, when the rates went from 9.5% up to 21%, well, an honest banker will say, well, I'm not just going to pay myself the lowest interest rate possible. I'm going to pay myself a competitive interest rate to what the banks would charge me, because that money is going to go back into my bank. And what happens is that when you're using the policy set up the way that Attorney Lester and others know how to do it, you're never actually taking the money out of your insurance policy. You're just collateralizing the money inside of your insurance policy. So for the case of me, when I had to take out my loan, it wasn't that I took that money out of my insurance policy. I called up the insurance company and said, what is the amount that's in my policy currently that's available for me to take out a loan against? They told me that amount. And I said, well, I want a loan equal to that amount. And then they gave me that loan. Now, if something were to happen where I wouldn't be able to pay that back, well, then what do? They just deduce it from that amount that's within that policy. And please correct me if I'm saying anything wrong, Attorney Lester, about how this works. But all that being said, the money in the policy itself becomes collateral, versus if you were to buy that tractor, the tractor is the collateral. You don't pay off that tractor, they take it. So in this case, let's say, for example, I've paid back my loan within a year's time. I added that money that I paid back on top of the money that was already in there. And that's part one of where the compounding occurs, is that, let's say that amount was $5,000. I add my $5,000 back on top of the 5 that I collateralized. Now I've got 10. But all of that time while I was waiting to pay back that $5,000, the 5 that was in my policy was continuously gaining interest. So it never stopped making interest. And once I put mine on top of that, plus the interest that I pay back to myself, you can see what happens. It begins to grow exponentially. And thus, you can get to a point to where you eventually no longer have to go to the banks of any type, credit cards, traditional banks, you name it, because you become your own lender and you treat yourself the exact same way you would treat a bank. And those are a lot of details I could talk about. I'll just close with this. Who do you value more? I'll just let that hang for a second. Do you value yourself more, or do you value the banks more? The banks are literally taking your money, and you would be better off taking care of yourself, right? So place the same amount of value, if not more, that you already give to the banks, i.e., again, if you're paying them that 21% interest, pay yourself that, because you value yourself more than the bank, I hope. But then what you'll find is that time goes on, you no longer are dependent upon the banks. And so that's what those two books are talking about. And I saw some people asked about putting the titles in the chat. I'll do so. But there are some specifics you need to know about it. So I think Attorney Lester, if people have any questions about that, and of course, we're opening up the Q&A for everybody, both Attorney Lester as well as Good Agriculture. Y'all can feel free to ask now. But that's just from my own personal testimony I wanted to share with you all, so that you can know that you actually do know somebody who uses this technique. You at least know one person. And, you know, there's a lot of other people who are using this as well and have been using this technique actually for several decades.
Thank you for sharing, Tanisio. Thank you. Yeah, so what happened, kind of more of my stories in 2010, the bank closed my home equity line of credit in spite of everything being in good standing and paid in full and no first mortgage on my home. Timing couldn't have been worse for me at that time. It left a bad impression in my mind. However, thankfully, less than 2 years later, I found out about the infinite banking concept. It changed my thinking about financing. So I decided to share the information and help others to obtain whole life policies, dividend paying whole life policies, to empower them to take control of the banking financing function in their lives, empowering others not to be in that same position or situation that I found myself in, where my line of credit was pulled. So here's some other resources here. But let me go back. Can you see that? So it's 3 other books on top of the other one. And one's by R. Nelson Nash. Do you have any questions?
And feel free to either place them in the chat or open your mics up. Either way is fine.
Any suggestions on who best to go through in order to take out a good policy? Who's giving the best policies to make a move like that?
Well, I'll do the plug, so you don't have to do it, Attorney Lester. I would say Kenneth Lester is a good one to consider, and by no means was this, you know, we didn't bring him to just promote him, but he is someone who I definitely trust. I think that was Khalifa that I heard speaking. And to just be fair to, you know, people's right to choose, you can always go to the practitioner search on the Nelson Nash Institute's website, and you can find people on there. But that's actually how I found Attorney Lester. I myself personally wanted to not only find an agent that was local, but I was actually also looking for an agent, preferably that was of African descent. And so that's how I learned of Attorney Lester. But Mary Jo Ehrman is a practitioner, and many others are on that website. So you can definitely, you know, use your democratic process of choosing. But yeah, I'm quite comfortable with Kenneth's services as well.
Thank you.
And I will say that if you're going to work with anybody, read one of those 2 books first. It's a lot of information that once you have read the book, your time will be better spent with the agent. Kenneth, for example, I put links in the chat. He already has videos online on his website that can help you get a lot of those kind of like small pieces of understanding out of the way before you come to him, because he really wants to help, but you got to kind of know a little bit about how this thing works so that you, again, won't ask questions that will really just not use the agent to their best ability. That's the best way I can put it. In fact, in the case of Mary Jo Ehrman, she won't even talk to you until you read her book. And there's good reason why, is because the key is understanding the mentality. It's not even so much about the system. It's about something, like I just said, mentioning how much do you value yourself over the bank? Mm-hmm. Or how much do you value this concept over rates of return, right? So if you're only looking at things from a rate of return perspective, then that means you only put your money into things that it will hopefully like generate some profit and bring it back to you. Versus in the model that he's showing you, you're actually not even going to need rates of return because your money is going to keep compounding on its own, which is guaranteed. A rate of return is not technically guaranteed. And technically, even this is not guaranteed, but we're talking about something that's had a success rate of what, over, I think it's like over 150 years, 200 years, something to that effect, Kenneth, that this has been utilized?
Correct. Predates the IRS, the Federal Reserve, the Great Depression. Yeah, over 130 years.
Right. And in that entire period of time, anyone who's used these type of policies and used it correctly, it doesn't fail because it's basically just compound interest. I'm sure many of you all have heard the classic, save 1 penny and then you double that penny, or you increase it by whatever the margin is per day. And at the end of 30 days, like you've got a sizable chunk of money.
Yeah, and within 31 days, you have 10,700,000. I looked at that chart again. I started to pull it up on this, but I didn't. But yeah, at the end of 31 days, if it doubles, you have over $10 million. And a lot of that doesn't happen until like day 28. People don't realize how much, from day 28 to day 31, how much that over time, the compound interest, the hook, the hockey stick, some people say the hockey stick action.
The J curve, if you will.
Right.
We have a couple of questions in the chat.
Okay.
It says, what does interest look like for borrowing against whole life insurance policies? So basically, what's the current interest rate?
It depends on the company. Right now, most companies are between 4 to some of them 6. I think one maybe 8, but they all have a different way they recognize the interest payments and the dividend, how they reconcile the dividends that they're, giving you each year against the loan. And some of them don't recognize. It's non-recognition and recognition. Some of those things, the terms I'm saying are explained in the book as well. But yeah, to answer your question, it depends on the company, but right now I've seen them, but they're going up because you want them to be profitable as well. Otherwise, you don't want them to fail. They need to stay competitive.
And mine for the loan that I did against my policy, I guess that's going on 6 months ago. No, actually it's about 9 months ago. At the time it was like 4.1, and now my company's moved up to 4.5. And to Kenneth's point, it's just so that they can stay competitive. You want them to be able to make money, because that's going to actually feed into the next question that someone asked about, what happens if the company goes under. Those interest rates increases allow them to create the money that they can then use to pay out dividends, right? And dividends meaning that is revenue that they'll pay to the owners of the company. So maybe if you could, Attorney Lester, talk about this second question: what happens if the company that issues the policy goes under? And maybe explain the profile of the type of insurance companies that are used for the banking system, because that's very important for people to know, especially those of you all who may have term policies. You may not know that there's different profiles of insurance companies, and you have to pick a very specific type that Attorney Lester will explain now.
Right. Generally speaking, we only deal with certain kind of mutual dividend paying whole life companies. Ones that, kind of like Tanisha was saying, have been paying out over 100 years. They're very conservative in nature. That's why they're not going to promise you 10 to 20% rate, interest rate guarantee, because they know that's not likely over a long time period. They're not tied to an index or a stock market in any form like that. They will make conservative investments, and they're not allowed to give out money like the banks on a fractional basis, where you give them 100 and the bank loans out 99 or 90%. They're not allowed to do that. They have to keep the money on reserves, and they have a different pool of money which they invest, and they have to be profitable in that pool of money. So that's kind of what happens. And I was talking to someone else in our group, actually, the same mentor is Wade, the same mentor that helped Mary Jo write this book, or help influence the book. I'm gonna say write the book, but influence the book. He had a message out to our group today where he said in his time period, which is over 40 years in the industry, he's only seen it one time where one insurance company, I don't even think it was a mutual company, that actually failed. He said the rest of the times they may be bought out, but they survived, unlike the banks. And the banks, since even in 2008, 2009 periods, 7 to 9, they had over 500 banks failed, and they've had like 3 in the last, 2 years now. And we're just wondering if there's going to be another shoe where, goes from 003, then another 300. Who knows? I mean, I'm not predicting that, not saying that, but however, we can look back over the last 40 years and tell you that none of these companies have failed.
And since this is a farming group, an agricultural group, I should say, I think most of you all should hopefully understand the concept of a cooperative. And so mutual insurance companies are technically set up like a cooperative is set up, to where when you own a policy within that mutual company, you are actually a shareholder in that company. And so as a result, They're going to look out for your best interest because you're an owner, and they're
Correct.
going to be conservative because you're an owner. They're also not going to have to put you through all the questions because you're an owner. And so as a result, the key to this is understanding that the mutual companies are the ones that are utilized, and these mutual companies are all companies that have been around for over a century.
Right.
And
it's
have been
only,
able to demonstrate their efficacy in, conservative use of this type of system versus the excess that we've seen, especially during the housing crisis, where people were just giving out loans just because. You didn't even have to really be qualified. They just gave you a loan, and the next thing you know, the adjustable rates occurred to where your loan went from one percentage to the next overnight. You couldn't pay it, and you defaulted on your loan and got your home foreclosed on. That's what happened. And so you won't see that. Well, I mean, again, I can't guarantee anything, so I'm throwing up a lot of air quotes tonight. But it's safe to say that if somebody's been doing something for 100 years, they probably aren't going to shift away from how they've been doing what they've been doing, is basically what we're trying to say.
correct. And they're not going to give you a loan. They're not going to allow you to collateralize something that's not there. So they don't get in a position where they're upside down in the beginning. You have to, you would have to have capitalized, meaning pay the premiums, pay the money to the insurance company to borrow against some of that money that you've paid.
Right. And that's why it takes a period of time before you can really start using it, because you're only going to be able to receive a loan on money you've put into the policy.
Right.
So if you go to the bank, again, if you put $1,000 into that bank, what's known as fractional reserve banking allows the bank, by way of backing of the Federal Reserve, the central bank, to give you 10 times that amount if you could qualify for a loan. So even though you might only have 1,000 liquid in that bank, depending on that relationship, right, that Alex and Kristen were talking about, you might have with the bank, they could technically give you $10,000. And it's not based upon your financial stability of liquidity in that bank. It might just be, well, your profile suggests you could pay us back. But they don't even have that amount of money in reserve in their vaults. It's not even sitting in the bank. So they're being backed up by another banker. In this case, you are the person that's investing into the bank and extracting from the bank. And you can only extract what you've put in. But when you've put it in and you leave it in, it continues to compound. It's just growing, even if you're not doing anything else except just putting that money in and letting the interest and that compounding effect take place. And if you take out the loan, this is what's key. You don't want to withdraw the money from your bank.
Correct.
So if you remember the chart, he was showing you, okay, you might save money. Let's say you want to buy a tractor. It's $20,000. You save $20,000 and now you go buy the tractor. Now you're down to zero. Well, now you got to raise more money to be able to take out another quote unquote loan from yourself, and it goes back down to zero. In the case of using the policy, you save up the 20 and you just take out a loan that's equal to the value of that 20 that's in there. But you're taking out the loan is not taking out the money, so that 20 is still growing while you have a loan that's collateralized that amount. And then when you pay back that 20, let's say that the loan, or excuse me, your policy now has $30,000 in it. That's just accrued by way of it sitting in there. When you pay back the 20, now you got $50,000 sitting in there. And so you never took money out and then kept making it go like this. It just continues to go up. So hopefully that makes sense to everyone.
You pay the insurance company money back, the interest for borrowing their money out of a different pool, not the pool, your policy.
Right.
You're borrowing against the policy, not from the policy. And they do charge. That's one of their things they have on their ledger is policy loans, because they're contractually obligated to give the loans. It's part of the policy contract language. So it's not a question of, are you eligible to get the loan?
They can't deny you. Can you explain what would happen if someone had a loan out and they were to pass away?
Yes. If you have a loan out, say your death benefit is 1 million, you have $200,000 worth of loans out there. So if you, when you die, you don't get both the 1 million and the 200, you get 800 because they take out the loan. So the beneficiary is not going to ask questions on that. They're going to take the money, keep going. Most likely. I mean, I know very few people that are going to ask questions about that loan. They're not going to even know it's been paid back. They just know that they received 800,000. So that's the way it's paid off.
Do we know, and I don't know the answer, I think I can speculate, what happens if you had a traditional loan with the bank and you passed away?
Well, it gets to the estate. That's, and you get
Right.
into legal law. But yeah, if the estate is like the person survived and they're required to pay the bills, quote unquote bills from the estate for any liability that's outstanding at that time.
And so one thing I'll say to everyone, just at least kind of closing on any points that I may have had outside of if y'all ask questions, is this presentation tonight is really like a both and, right? Figuring out how to really scale. So I can tell you this much, I've used the loan that I've had to buy an investment vehicle. And that investment vehicle is creating its money. I'm still paying into my policy just like I would normally. So I'm not technically paying down the loan just yet, but the investment vehicle is creating enough capital off the principal I invested that once it reaches the point that it's the amount that I took out on the loan, I'm just going to pull from that investment vehicle and pay back my loan. But I've also still leveraged business credit. I definitely have leveraged personal credit. The goal is to get to the point to where my policy eventually outweighs all of those.
Right.
So one day, whatever that credit card amount is that I have, my policy should be more than that. And then wipe that out of the way and just stick with my banking policy. And with that being said, Attorney Lester, could you talk about how multiple policies could be of benefit to someone?
Right. Because once the policy is built and designed in the beginning, you may have windfalls, kind of like I think someone was talking about the windfalls earlier. You may have windfalls, but you can't put it in this one policy because it's already built out. So you'd have to get another policy. You could have multiple policies as long as you have insurability. As long as you still have insurability and you're approved, you can get multiple policies up until your insurable interest.
There was someone who asked a question directly to me. Maybe she doesn't want me to state who she is, but I'll just at least say it out loud and answer it, which was, do you pay back incrementally or in one lump sum? My answer to her, so you correct me if I'm wrong, Kenneth, was it's your bank, so it's up to you.
Right. You're just required to pay that interest every year.
That's it.
They're not going to send you a payment like an installment, pay on the 5th, pay on the 6th, or pay on, no, they're going to send you a statement once a year saying, this is the interest due for this year, if you have an outstanding loan, and here's your premium for this year. That's it. So it's up to you. So you have to, that's why throughout the book, he tells you it's about, the first half of the book is really about human nature, the mindset. That's kind of what we have to go back to, is and that's why Mary Jo and others, if you can't have, if your mindset is not right, it's not going to work, because it's not a shortcut. It's definitely not a shortcut. It's long range thinking. It doesn't happen overnight. You can't steal the peas. You got to treat your bank better than you treat Wells Fargo. You should want to treat your family better than you treat anybody else's family. It's kind of that thinking. You have to be an honest banker, which requires to be a saver to begin with. So if you got the human nature, which we all do, we have to fight that human nature, the basic instinct to steal the peas out the back of the grocery store, out of your own grocery store. Because why am I paying for my own money? Well, because there's a cost every time.
In fact, I can definitely relate with that. So y'all find this funny if y'all know Dr. Ruby Thomas. Some of y'all know who that is. She has to pay for groceries from Nature's Candy Farms. So, we don't harvest food from Nature's Candy Farms and then put it on the table. We buy food from Nature's Candy Farms. So it's quite literal. Like he said, you don't steal the peas out of your own grocery store, you buy them. Some of y'all may be a little more rough or hip hopish, so I'll use Biggie's verse, never get high off your own supply. But however you want to think about it, the key is you want to already have the mindset that you're putting into your bank, the same way you would be forced to do so for another bank. They're forcing you to do it. So you need to be willing to do it for yourself, and then look at the benefits that you're going to get once you do that. And in the case of R. Nelson Nash, at the peak ownership of policies that he had, I think he had 48, if my memory serves me correctly, Attorney Lester.
Yeah, it was over 40.
Yeah, so this
quite a
man
few.
was literally buying policies on when his grandchildren were born, you know, just different reasons. And then when it got down to its lowest number, I think it was in its 20s. And there's different reasons why you would do that. And all of that, again, is explained in the book. But, you know, again, this is something that people are realistically doing. And you all have probably heard about it in some way, shape, or form because it's starting to become popular. So that's one thing I want to emphasize too. If you're talking to someone and they don't know, not only do they not know about the infinite banking concept, but I'll even be willing to just say if they're not an authorized practitioner, I would just proceed with caution. Because what's happening now is people are utilizing other policies that have been established over the years and trying to utilize quote unquote IBC style techniques with policies that are actually not structured correctly to allow you to be a banker. So they're really selling you on policies that utilize market rates to, again, be able to build up their cash value. And many times they're also not talking to you about the mindset. So if you don't have the mindset and you don't have the policy that's structured correctly, you can have something that's kind of a pseudo bank, but you really want to deal with someone who's IBC certified. So again, you know, if you go to the R. Nelson Nash website, I guess the Nelson Nash Institute, you'll see everybody that they have throughout the United States that's actually IBC certified. They've been trained on how to establish your own bank. And yeah, I think that's just, you know, something that's sensible, especially considering that as farmers, most banks don't really know how to validate what we do as a good investment for their own portfolio. Mind you, if you take out a loan, you're a part of their portfolio. And it's got to make sense for them to lend to you. And as Kirsten was talking about earlier, oftentimes we're trying to sell them on something that they just don't get unless you're at a larger scale where it can be justified. So all that being said, you know, I think it's something worth looking into.
Yeah, I would, from listening this one time, I would take advantage of those grants, anything that, I don't know, I think she used the word shoehorn, whatever you're already doing. And if it fits, I would be researching. I would use that, start banking. I'd be start where you are, you know, start where you are and create your own. And then, you know, because I was the one who asked a specific question, is there need based or not? So if it's not need based, you can have your own bank going. And as long as you keep fitting these boxes, checking the boxes, you can get the grants. I mean, that's my understanding. That's my very, very elementary understanding. I don't, you know, probably want to go to Alex or Kristen to get more information on that, or Tanisio probably can help you that as well. Cause I think you worked at, do grants for who, SRE or someone?
Well, I'm a reviewer for SARE.
Yeah.
And so in case any of y'all missed that earlier, if you have any questions about the SARE grant, I can answer that for you. Because I'm one of the people that literally looks at the applications, or the proposals, I should say, when they come in. And even just if you wanted to get the perspective of a reviewer, regardless of if it's a SARE grant or not, I can tell you what we as reviewers are looking for. And most of the time it's just, does what you're writing make sense, not only grammatically and, you know, legibly and all that good stuff, but conceptually. You might think that it makes sense, but we might have some critical questions about how you're going to be able to pull off the project that you say you're going to pull off. And those are the kind of things that will make us decide whether we should fund you or not. So, Alex, Kirsten, I know we're kind of, I don't want to say we're filibustering the conversation, but I definitely want y'all to have an opportunity to offer any feedback or, you know, field any questions as well, too.
Yeah, maybe we just talk through some additional resources really quick before we wrap.
Sure, go right ahead.
Kirsten, are you still showing slides?
Yep. Are they showing?
It's showing the
Here's
cow.
the cow.
Yeah, the cow is a slide.
Okay.
So we have a number of resources. The one that I have spent most of the last 6 months working on has been our funding tool that sits on goodagriculture.com. It's super simple, 50 yes/no questions, and we will send you a list of the funding opportunities that you're eligible for. Our newsletter also emails out opportunities once a month. There are plenty of other newsletters for grant opportunities. ATRA is a really good one. Excuse me. NRCS has different funding opportunities. Most farming newsletters will list funding opportunities as they find them.
I think the next slide has some of
There we
those.
go.
So-
Yeah. Federal funding opportunities generally have informational webinars. So they will record those and put them online, but it's best if you can get there in person. Your county and state FSA and NRCS offices will often either have grant opportunities listed on their website or have newsletters that include grant opportunities. And if you're writing your first grant, reach out to someone who's done it before, because there's a specific language that you can use. There's a specific, just attention to detail in terms of dot every single I, cross every single T. There's a logic to federal grants, especially, that is not obvious when you first look at it. So reach out to other farmers, reach out to local nonprofits. You can reach out to us. We do offer a grant writing service, and we do not charge you unless you win the grant. So there's no risk upfront from that perspective. And then we have 3 more of the webinars in this series. So you are now signed up for the rest of the series. You don't need to worry about checking in and signing up each week. For farmers that are in the Metro Atlanta 11 county region, reach out to us. We will be happy to work with you, cost covered by this particular grant that AgLanta and East Point Grown are working with, to figure out what funding opportunities are a good fit for your farm. For outside Metro Atlanta, take the grant survey and we will work with you. Grants are really our bread and butter, and we do a lot of them. So March 20th, we have our operational analysis webinar, which I'm super excited about because we are working with another local farm that has a really nice deep data set, and we're doing analysis for them that they've agreed to let us put in this webinar. March 27th, we are going to be doing business cases. So, if you're questioning what you need to have to go to the bank, you want to be at this webinar. And then on April 3rd, with QCS, we have Organic Certification 101. So if you have any interest in getting organic certification, you will definitely want to reach out and attend that one. And finally, reach out to us. If you've got questions, please reach out. And I was supposed to add Kenneth's contact information on this slide too, and I forgot. I apologize, Kenneth.
And I saw Tunisia was doing a little feedback survey in the chat, but the team will also send out a feedback, or there will be a feedback survey at the end of this Zoom. So please take that. That's really helpful for us to keep improving this.
Yes, as mentioned, Zoom will automatically distribute a survey once you exit out of this meeting. So please fill that survey out. And as Kirsten mentioned, you have automatically been registered for the next 3 webinars, but just make sure it shows up on your calendar for the next 3 consecutive Mondays. And we hope to see y'all back again. As promised, this was such a dense opportunity to learn and engage, and we will be sending you these presentations in email form, as well as a contact list, so you all can stay engaged. And thank you so much for your time. You'll have a great
Good
evening.
night, everyone.